Happy Friday, everyone, and welcome back to Your Finance TV. It's the first Friday of the month, so you know what we get with that? We get a wonderful monthly music from Jay Pelosky. Goes through everything for us. How are you, Jay?
Pretty good, Scott. Pretty tired because I did, in fact, go through everything with this monthly.
Well, as you always do, and it's a really great review of the market, especially considering how much happens in the market over the space of a month. Now, the title of your musings this month or this month is the birth of the new, and I suppose with the S&P getting through 4,200, that just means everything's rosy and everything's new, and the world's back on track, right?
Well, I mean, I think the world kind of has been on track, but a lot of people have not been able to or willing to kind of recognize that. And so this monthly, as we do every month, it's a deep dive, as you pointed out. This one, the executive summary is about 900 words, so you can read it in 2 minutes. But the full doc is about 5,800 words, 23 different charts and tables from over 20 distinct research sources. So, really cover the bases. And the focus is kind of like we've been in this, a world that's been kind of sped up, right? We've been in the COVID world, the world of climate adjustment, the world of conflict with Russia's invasion, and all in an age of speed, which we've done a lot of work on over the last several years. Regular readers of ours know we talked about climate speed, analytical speed, narrative speed, etc. But now that we're moving past that, it's time to kind of think about what's coming next. And we think what's coming next are some major changes that are just starting to unfold. And so we title this monthly The Birth of the New. And so birthing, as we know, takes time. It's often messy, and it can mess with your head. And so part of the messing with your head is for us as investors, we're going to need to kind of slow down a little bit and absorb the changes that are taking place from the new Biden doctrine on the geopolitical front to the high growth world, the high nominal growth world that we've been talking about, onto the new industrial policy in the US and Europe, first time in 60 or 70 years in the United States, and then on to the global AI-inspired productivity boom, which we've been talking about and which we really start to see manifesting. And so we put all this together, and in our view, these changes are going to kind of dominate the global landscape for the rest of this decade and will really dictate the global cross-asset market pricing and performance. And in the interim, as we move through this, in the near term, we continue to be focused on what we've been calling the twin rotations. Remember, we talked about rotation 2 or 3 weeks ago. The rotation from big tech to cyclicals in the United States, and then the rotation from a decade of US equity-led leadership to leadership led by the rest of the world, particularly the developed markets of Europe and Japan. So that's the near-term focus. The longer-term focus is to recognize that we're birthing almost a new global order, from geopolitics to economics and to markets. And that's exciting, but it's also a tricky time where you have to have some patience, you have to pay attention. And as we say in our piece, if you know, you know.
See, now, offline, you and I
You don't
spoke,
watch
and you
enough
referred
TV,
to,
my friend. Just
yeah,
look
you
what
referred to
happens
Pizza
out
Hut.
there. It's a
I
Pizza Hut
never,
one.
we don't have Pizza Hut near me. I remember Pizza Hut as a kid, and it was big, thick pizza in Australia at that stage. And I think it used to be like, I'm going way back, it was $5 all you could eat sort of stuff. But
Yeah, no, this is from the playoff hockey and playoff basketball. I've probably seen 100 Pizza Hut commercials, and so it's in my brain. If you know, you know.
now, for viewers who haven't watched Jay's interviews before, when we do these monthly pieces, he breaks it down to 5 different segments: climate, economics, politics, policy, and markets. So it's a great little quick rundown for you to get right to where you need to get to. So we're going to start with climate, Jay, and you expect climate-related equity investing to pick up now that we have moved past COVID. It's interesting because we're seeing some of these ESG funds pull back a little bit and so forth. There's not as much money going into it. What are you thinking on this side of it?
Yeah, first of all, this is not ESG related, right? This is
Okay.
climate investing. We're talking about solar. We're talking about electric vehicles. We're talking about lithium and batteries and nuclear power. We're not talking about ESG. So that's an important distinction that we want to make. And, climate investing has been a roller coaster, right? We had a tremendous lift in 2020, a sharp ugly pullback in 2021. And really, since then, they've been marking time, kind of going sideways in a range. And our thesis is that as we move past the COVID and the inflation spike and the energy shock, that as we move past that, the focus on climate, now that the spending with the U.S. Industrial or Inflation Reduction Act and the Green Deal Industrial Plan in Europe, that spending is starting to manifest. And we highlight, in fact, that renewable power this year is going to install 107 gigawatts, which is a record amount of power powered by renewables. And so that's all taking place. The money is now being spent, and we expect the focus to kind of shift back to climate investing because, it is a kind of an alpha play, right? It's not a beta play. It requires some confidence. It requires some excitement and some enthusiasm. And obviously, when you look at sentiment indicators for the markets, enthusiasm is something that has definitely been missing. As that comes back, climate investing as we define it, we believe should catch a bid.
Okay, so let's move on to economics then. And obviously, we've seen a slew of economic data as you do every single month. Now, some of we'll get into policy later on, but some have said that gives a sign that we're going to see a couple more hikes. I know you're not a believer of that, but some are also talking about the recession as inevitable. Are you a believer in that?
Yeah, no, it's definitely. The market has been pointed in the recession direction. Certainly, fixed income has been with the rate cuts that were anticipated. Remember, was only a couple of weeks ago where the fixed income market was pricing in 75 basis points of rate cuts by the end of this year. That's now been pretty much fully taken out of the bond market. And we think that is the bond market reflecting on the fact that a recession is unlikely. Stocks, however, are still certainly sentiment-wise and position-wise expecting a recession. And you can even see that in the cyclical sector behavior within the stock market. But, sticking to the economics, as we'll talk about the markets at the end, but sticking to the economics section, right off the bat, we look at the S&P Global PMI Composite, hit a 13-month high in May. The global composite, so services and manufacturing for the whole world, hit a 13-month high in May. And yet people are convinced we're about to have a recession. China's even more funny, right? China is growing at about a 4.5% to 5% clip. Most expected to grow between 5% and 6% this year. Retail sales in April were up 18% year over year. And yet people are talking about China going into recession. There's just such a gap between where the economies are and where the mindset of the media and the investor base is. And we see the same thing in the US, right? 2022, what were the drags on the US economy? Housing crash was a big drag, right? Inventory destocking was a huge drag on GDP. And then all the tech related layoffs. Okay, that's 2022. What is 2023? Housing has bottomed. If you look at almost any indicator, price, mortgage applications, builder sentiment, all have bottomed. The inventory destocking has run its course. Again, look at all the retail stores that reported in Q1, all said their inventory levels are much more in line with where they should be. And then tech, AI, right? There's an explosion of enthusiasm in technology. And so it's the same in the rest of the world, right? If you look at Europe, Europe's composite is well above 50. Inflation, the latest inflation data, much better than expected. Now looking for the ECB to pause at some point over the next couple of months. In Japan, their PMI composite just hit a 10-year high, right? Japan is exiting deflation. It's one of the most exciting economic and financial market stories we see anywhere in the world. And we expect China to start to produce some new measures to support its property market and really drive domestic demand, which is the big move for China. China is trying to shift from an export and investment-led growth model to a domestic demand-led growth model. And just to put that in perspective real quick, one data point, and again, we have 23 charts and tables throughout our monthly. China's household consumption equals about 38% of GDP. To put that in context, in the US, it's close to 70%. So China's move is from exporting production to the rest of the world to producing for domestic demand as the economy grows. And that's really the thing we're looking for in China. But put it all together, the world is, we believe, in an early cycle economic recovery led by Asia, Japan, and China, followed up with Europe, the US coming up behind, and we're not going into recession, either in the US or in the rest of the world.
Okay, well, let's move on to politics. And obviously, the debt ceiling's done. That's easy. That's either the next president or Biden's issue in a couple of years.
Yeah.
What else do we need to worry about on that front, the politics front?
Yeah, well, I mean, the debt ceiling issue is emblematic kind of the fecklessness of U.S. policy. We claim to be a global leader, and yet we have this kind of, foolishness, really. There's no other way to put it. There's absolutely no reason for the debt ceiling crisis. There was no big change that was agreed upon by the two sides to move forward. And it's really just an example of kind of the lack of leadership, particularly on the Republican Party side, in the view of at least this author. But the focus on politics really for us is, again, we're global macro. So our focus is on the relationship between the U.S. and China. And there's been quite a bit of movement on that. There's a new Biden doctrine focused on de-risking. Right? So de-risking the relationship with China. Some have called it decoupling. The president and his national security advisor, Jake Sullivan, who produced a very important speech in Washington a couple of weeks ago, disagree with decoupling. It's more about de-risking. So de-risking has a couple of parts. One is a new industrial policy in the U.S. So to build more in the U.S., more in the Americas, and that fits right into our tripolar world of regional integration in the Americas, Asia, and Europe. So that all makes sense. And then on the tech side, I like the phrase small yard, high fence. In other words, there are bits and pieces, particularly the cutting edge of technology, that the US is going to be less willing to share with China. And in turn, China is going to be less willing to share with the US. And so there is a little bit of separation on the tech front, but let's keep in mind that we import, I believe, somewhere around $500 billion a year of goods from China. And so we're not going to decouple anytime soon. But that's really the political dynamic that we're paying attention to. And so we included in our monthly several pretty chunky paragraphs, actually, of text on that speech, because we do think it's that important for people to kind of understand from a global perspective how the relationship between the US and China is likely to unfold over the next couple of years.
Okay, well, I sort of led us a little bit astray earlier on the policy side of it.
You do that, don't you?
I do. I have been known to do it before, and I will do it again. So, all right, listen, we touched on it, and obviously you can go back over it again, but do you, listen, this is coming from me, do you really think we're going to, over the next couple of meetings, we could see another 25 pip hike, or you just don't think it's going to happen at all?
No, I think the Fed is done. They basically signaled that they're not going to raise rates in June. I mean, you see the market reaction to the labor data today, right? We're talking on Friday, June 2nd. So we just had the jobs report, much stronger than expected, though average hourly earnings were actually a little bit better than expected. And that's where the Fed is focused. So kind of confirming the idea that in June, in a couple of weeks, the Fed is not going to raise, is going to go on hold. And we think the May inflation number that will come out just before the June meeting, and then the June inflation number, which will obviously come out in July, are both going to signal significant downshifts of inflation from year ago levels. Because a year ago in May, inflation was running at about a 0.8, 0.9% rate. In June of last year, it was 1.2%. So we're now in the 0.4 to 0.5% range. So we think inflation in the U.S. will, at a headline level, be under 4%, year over year with the June inflation number, which will come out in July. So we think the Fed is done effectively, right? And we're ending the most aggressive rate cycle of the last 40 years. And beginning, we think quite quickly, we're going to shift to a rate cutting cycle on a global basis, not the Fed. We expect the Fed to go on hold, no rate cuts the rest of this year, Fed on hold throughout the rest of the year because there's no recession, economy's recovering, no need to cut, no need to hike, just on hold. That's fine. The analog is the second half of the 90s. We have a great chart showing exactly that. Fed went on hold, 94, 95, held across for several years. Stock market continued to go up. That's the analog we expect to see play out. And so what we're really focused on is for the Fed to update its growth forecasts, which it will do in June. And we expect higher GDP estimates for this year and next year, much as has just happened in Europe and in Japan. Governments raising growth estimates. And we think in the US that's critical because that will put paid to the idea of recession. And then that in turn sets off the equity market rotation we touched on at the beginning from big tech to the cyclicals. And we can continue that as we go into the market section.
I see. Now you're stepping into my territory then, like getting into the next questions. All right, I know this game. Okay, let's talk about markets. We're through 4,200 on the S&P, right? And that's been a huge, big resistance level for people. Are we off to the moon? Is this market so great it's just not going to stop, Jay, or are we overdone for now?
Well, I think big tech has had a huge move, and it needs a rest. And so, it's very overbought. If you look at NVIDIA, if you look at the Qs, if you look at SMH, the way we're playing AI is through a heavy allocation to semiconductors, which we see as kind of the pick and shovel of the AI age. And we expect big tech to be okay because, look, let's remember, 2022 was a devastating bear market for big tech. Let's remember that it was very much at risk to the rapid rate hikes that we've seen. Those are now off the table. So big tech has had its bear market, is no longer at risk to significant rate hikes, is a decent hedge against recession, and has AI, which has kind of got its moat around it because it takes huge amounts of money to develop these large language models. So big tech is kind of in a better place than we thought it was going to be 6 months ago, before we got to the end of the rate hike cycle, before we got to the AI explosion. So we have positions there and we're holding them. That rest that big tech now needs to take after having had a humongous run allows space for the rotation to the cyclical sectors, which have been pretty mediocre. And here we're thinking financials, energy, industrials, home builders, and transports. All right, we have 5 separate positions that we've grouped into a cyclical. We're really running, Scott, like a barbell, right? Back in the day when you used to work out, you had a barbell. Like how I snuck that one in there.
I did.
You have barbell, right? So we've got big tech on one side, with heavy semiconductor exposure. And then we have cyclicals on the other side. And that's the barbell that we're using within our US equity allocation for our global multi-asset model portfolio. All right. And then the other barbell is the rotation we expect to see continuing to unfold. It already has begun, which is the shift from leadership, US equity leadership that we've had since 2010 in global equities to rest of the world leadership, which we started to have over the second half of last year and through this year, where Europe has really led the way, and more recently, Japan breaking out of that 30-year deflation environment. Japan is really starting to move as an equity market. So those are the two barbells within the global multi-asset model. And then within our TPW 20 thematic model, we have the barbell of future tech. So we look at things like ARC FinTech, which is breaking out. I mean, there's stuff happening in the markets, which is really kind of exciting. You touched on it, 4,200, an important resistance level. We think the rotation is going to take us up to 4,300 and potentially beyond. And that is important because 4,300 marks a new bull market from the October low. And so we think a combination of the Fed raising its growth estimates, rotation into cyclicals, taking us through 4,300, kicking off a new bull market is going to bring in a lot of the bearish cash on the sidelines, the $6 trillion of money market funds that are sitting there. Yeah, I mean, yes, cash yields more than it did a year ago, right? No argument. But right now, we're talking about in the first half of the year, global equities are up somewhere around 10 to 12%. Cash, US dollar cash, is up about 1.5%. So it's a massive drag on anybody who's running an ACWI benchmark portfolio and holding cash. And that's what people don't seem to want to talk about. If you're telling me you're holding big cash positions, then almost by definition, you're massively underperforming your benchmark. And so as we break higher, that's going to pull more people in. And they're going to take people like us at TPW Advisory and our clients who are fully invested in overweight equities, and we have been since the middle of last year. That's going to take us higher. And we're very thankful for that. But that's really kind of the outlook as we see it on the equity side. Just to wrap up quickly, the rest of the assets have been and remain underweight fixed income. I think we're getting to a relatively decent position, as we talked about earlier. The idea of rate cuts has been taken out of the fixed income market. That's, in our read, that's the fixed income market telling us not to worry about recession. We think that's correct. We think the equity market is behind on that, and as it goes higher, it will price out the likelihood of recession. But we continue to be underweight treasuries, overweight credit. We like emerging market local currency debt. We expect the Fed on hold to equal dollar weakness, which equals rest of the world equity outperformance, commodity outperformance, and climate outperformance. And so commodities has been a big drag, right? Again, this issue of destocking and restocking. So the physical demand, here's an example in a nutshell. Energy Intelligence put out a note a week or so ago showing that China's demand for oil in April, 16 million barrels a day, was a new record, okay? A new record for demand for oil in China. And what did oil do in May? It was one of the worst months in years, down 12%. WTI was down 12%. So again, a huge mismatch between the demand side, which remains robust, and the price action in the commodity space across the complex, because copper had the same month as oil did, both down 12 to 15%. So we expect that to also pick up. And it's really been what we've been talking about, right? To finish up, it's been a period where if you've had these positions on, as we have had, you need to have had patience. And this is kind of this idea of the birth of the new, going from a sped up COVID-led world to a new world where big changes are taking place. Big change by definition takes time. We have to be patient with it. And for us, those barbells and thinking about rotations is the way we're approaching it. And so we continue to be pretty constructive for the second half. We do think non-US equity will outperform. We think China equity, for example, ready for a bounce here, significantly oversold, commodities oversold, ready for a bounce, cyclical sectors in the US ready for a bounce. So a lot of opportunity that we see in the birth of the new.
Well, Jay, thank you so much for that rundown. And I hope you're going to have a great weekend because the weather looks fantastic out there today here in the Northeast. So go grab yourself a drink. And after I have a big write-up for this great report. And for all viewers, you can actually go to pelosky.com to sign up for these musings. Jay, have a great weekend and thank you again.
All right, Scott, great to see you and enjoy the Saturday morning rugby match.
Thank you. For everyone else out there, good luck investing.